Good morning, everyone, and thank you for joining us here today. My name is Fiona Gaskin, and I lead the Sustainability Reporting and Assurance team here in PwC Ireland. I have the pleasure of leading you through today's webcast. From a European regulatory perspective, it's been a year of uncertainty. And yet, what we found when working with clients during that time is it's allowed them the time to step back and really refocus on why sustainability topics matter to their business, outside of just required reporting. There was a re-emphasis on the business case and the linked core strategy, which I think is what we all really want to see in terms of what gets reported. In some cases, having taken this step back, companies who now find themselves outside of the scope of CSRD are still pursuing more formal sustainability reporting and assurance, focusing on key areas. There's also the wider global context to consider, and Catherine's going to take us through all the latest developments in both Europe and wider afield. I mentioned at the outset the refocus on core strategy. In particular, this has been very evident in the area of climate reporting. Given how many businesses list this as a principal risk, it's hardly surprising that this is an area that we've seen organisations really focus on. And Luke is going to bring us through how ambition can be turned into action. In terms of the business case, tax incentives and credits can play a major role in supporting projects. And Sinead is going to bring us through what to look out for in relation to those. Please ensure to join in on our discussion by posting your questions and comments using the live Q&A function on your screen, and we'll do our best to respond to them during the webcast. If you aren't able to get to your questions during the webcast, we'll be sure to follow up with you by email afterwards. So before we get into it, we're going to have a quick poll. So if we have the first question up, please. So the question is around what are the barriers to sustainability in your organisation? And there's a couple of different options there in terms of senior leader buy-in, regulatory uncertainty, financial skills, or other. So we'll just give people a moment to answer. Okay, so well, exactly 50-50 between senior leader buy-in and regulatory uncertainty, and certainly, we've a bit more mixed results now. A few more for financial skills and other. It's the regulatory uncertainty that's really winning out here with 42%. So not far off half the audience finding that to be a challenge, and certainly that has been a major challenge over the last year, especially in terms of feeling like it's a moving goalpost and wanting to meet requirements, but perhaps not exceed them. And certainly, as we said, with those moving goalposts, it's been difficult. But here to help you navigate exactly what the position is now is Catherine, who's going to bring us through an update on both European and then more broadly global reporting landscape, which, as we said, is ever evolving. So Catherine, over to you.
Great, thanks Fiona. So I'm also going to start with a poll now just to get a bit of a sense of what standards and frameworks that you're going to plan to report against in 2026. So we'll just have the poll sent there and you can see the different options come up on your screen. It's got CSRD, the VSME. I'll just give everyone a minute there to choose. We've got a few coming in there for CSRD, which is probably our Wave 1 clients who are reporting at the moment. So also some choosing there the VSME for this year as well, which is good to see. Okay. Yeah, and then there's a few that aren't planning to report this year, which probably isn't surprising because a lot of the requirements come in for next year onwards. So still CSRD coming through, and then TCFD, quite a lot of people reporting against that still.
So Catherine, a big interest there, I'd say, on the European side in terms of regulation. So maybe we'll start off with if you could bring us through what's the latest for the omnibus. And the first question identified regulatory change as being a particular challenge. So maybe hopefully you can help clarify for all involved.
Yep, so it's been quite a turbulent year, I think everyone would agree, on the European regulatory side. So there has been a bit of certainty in the last few weeks on the actual omnibus directive was published in the official journal of the EU on the 26th of February, which actually turned out to be a year to the day after the original omnibus proposal was published, which started all this turbulent times. So that directive is going to come into force 20 days after publication in the official journal of the EU. And then EU member states, they'll have 1 year, 12 months after that to transpose into national legislation. So that means that each EU member state needs to transpose it into national legislation by mid-March 2027. So I am going to go through the main changes in the directive in a moment, but just one thing to say that none of these changes actually apply until it's actually transposed into Irish law. So we are going to be reliant on the Irish government transposing it as soon as possible. So the Department of Trade, Enterprise and Employment, they're working through the amendments at the moment. They're on the third version apparently. So they're hoping to publish the final directive into national legislation by the start of Q4 this year, which will be great to bring a bit of certainty. So there is always chances that there will be changes throughout this transposition, but it is probably unlikely that it's going to change who is in scope. So it's just good to keep an eye out at that over the next few months. So I suppose the biggest question is, what are the changes? Who's now in scope for CSRD? So from an EU entity perspective, it has narrowed. So it's just for EU entities or groups with more than 1,000 employees and more than 450 million net turnover. So they're going to need to report in 2028 on FY 2027 data and then annually thereafter. And they're going to report using the new updated ESRS. So listed SMEs are now excluded. And from a non-EU entities perspective, they're required to report on a global consolidated basis if they've got consolidated turnover over 450 million in the EU, and also a subsidiary or branch in the EU with turnover exceeding 200 million. And I would just say for the non-EU entities perspective that the thresholds there are only on revenue and the number of employees doesn't matter. So they'll be required to report in 2029 on FY 2028 data and then annually thereafter. And also they're going to be reporting for different standards than the current ESRS, but they haven't yet been published, so it remains to be seen. So the Omnibus Directive did bring in a few other changes. One of the major ones is what they call the value chain cap. So that means if you're requesting data from an entity that's out of scope of CSRD, so for example, with less than 1,000 employees, you can only request what's in the future VSME. So that is quite a standard set of data points. So also you still do need to get third-party assurance, but it's going to stay as limited assurance, not reasonable assurance. And also the requirement to issue sector-based standards has been removed. So I'm just going to go into a bit more about the revised ESRS. So that's the European Sustainability Reporting Standards. So that's running on a parallel track to the Omnibus Directive with just a slightly different timeline, quicker timeline, thankfully. So this also was requested as part of the original Omnibus package last year, with the European Commission asking EFRAG to provide technical advice on some revisions to simplify the ESRS. So EFRAG delivered the draft amendments on the 3rd of December, just in time for everyone to read pre-Christmas. So revisions to the ESRS, they are under consultation at the moment. So a lot of the EU institutions like the European Central Bank, ESMA, etc., they have given some feedback, which has broadly been quite positive, but they have raised a few concerns about the relief mechanisms and also some data reductions, which does suggest that there will be further changes to the current drafts. So also the next stage after that is there's going to be a public consultation in April of May of this year. And then the plan is to have them adopted by a delegated act in mid-2026, but it'll be no later than mid-September of this year, which would be 6 months after the Omnibus Directive entered into force. I would just say, until this delegated act is effective, Wave 1 entities, they have to continue applying the current ESRS.
Thanks, Catherine. Any further areas of change that you want to bring us through in terms of the detail of perhaps some of the specifics?
Yeah, so I suppose a lot of people will have seen the headline of the 61% reduction in the mandatory data points. That doesn't necessarily mean, though, that that's going to be a 61% shorter sustainability reports. Unfortunately for some, I suspect, because there has been some topical standards have had more changes than others. So it really just depends what your material topics are. They have removed a lot of the duplication in a lot of places, which is good, should be a lot more streamlined and easier to read. So some of the other major changes, though, that they've brought in, that ESRS is now going to be a fair presentation framework, which is going to bring it closer to what's in the IFRS reporting standard, as well as ISSB reporting standards. So that's good for a bit of comparability. From the double materiality assessment, there's been some simplification. So you can now have the flexibility to do your assessment at a top-down basis, or from the level of the IROs, the bottom-up, or a combination of both. It does mean if you're ruling out topics when you're doing it from a top-down perspective in the first place, there's quite a lot of judgment involved. So it's really important to document that up because your auditors won't like judgment and will want to see how you came to that conclusion to make sure that it's reasonable. There's also been a bit more guidance on the gross versus net, and also the list of sustainability topics within the ESRS has been streamlined with the removal of subtopics. So one of the major changes that has come through is about new reporting reliefs, which are permanent, and this is where there's been a bit of discussion on feedback to date. So for acquisitions, you don't have to, you can defer including them into the next reporting period. And also for disposals, you can exclude the disposed business from the beginning of the period in which it was disposed. There is this other one called undue cost and effort. So it says that, you have to use all reasonable and supportive information that's available to the undertaking at the reporting date without undue cost or effort to a number of the requirements. And it really depends to be seen how that is going to work in practice. And again, that's going to be one for a discussion with your auditor if you feel that you want to use that. So if you avail of any of those reliefs, you're going to have to disclose that within your statement, and those reporting reliefs are permanent.
Thanks, Catherine. I envisage between the fair presentation and the undue cost and effort, there'll be lots of discussions between reporters and their audience and indeed consideration of stakeholders over the next couple of years. There's a lot of judgment involved in all of those areas. Quite a few of our audience, Catherine, were kind of interested in outside of Europe as well, so kind of on the more global stage. What can you tell us around what's happening there?
So I'm going to start off with a bit from the US. So from the US, California is leading the way. So back in October 2023, California enacted climate disclosure laws that pretty much changed the climate reporting landscape in the US. But quite soon after those laws were enacted, lawsuits were filed challenging them, which has meant that any reporting on them to date has been voluntary. However, there is a bit of good news. So on the 26th of February, as you can see, there was a very busy week at the end of February for all involved in sustainability reporting. The adoption of the underlying laws, regulations for those climate disclosure laws were now adopted, and they've been submitted to the California Office of Administrative Law, which is kind of the final step. So that'll be their final review and approval, with the timeline unknown, but it's estimated to be in the next few months. So I'm going to cover two of the laws just in a bit more detail. So one thing to call out for these California laws, they don't just apply to US headquartered companies. They apply to US entities with annual revenue over certain thresholds that do business in California, subject to certain exemptions. So the first one that I'm going to cover is actually the one that now has a reporting deadline this year. So the first law is in relation to reporting on your scope 1, 2 and 3 emissions, your greenhouse gas emissions, in accordance with the Greenhouse Gas Protocol. So the first year reporting deadline for that is now being confirmed that you need to report on scope 1 and 2 by the 10th of August of this year, and scope 3 will follow in later years. The other one that I wanted to touch briefly on is in relation to the climate-related financial risks. That one is actually still under a lawsuit. So that means Reporting on that one is voluntary at the moment, but actually in a good news, by the 3rd of March of this year, over 130 companies actually had already voluntarily reported against it. So it's just really good to see that, you know, US entities that are doing business in California, they still actually are voluntarily reporting, because I know sometimes if you listen to the news, you'd think that climate is completely gone in the US, but it's not the case, which is great to see. And it's also great to see that last year it was just the California laws, everything else kind of stayed by the end of the year. But very early this year, again in February, the New York State Senate passed their equivalent of the California greenhouse gas emissions rule, and they have it very similar as well, that, you know, it applies to companies that are doing business in the state with revenue over certain thresholds. It does still need to pass the state assembly, but it is moving through. And they're also working on a bill to bring in reporting on climate-related financial risks, but that one has made limited progress to date. Also, New Jersey are looking into an emissions reporting rule, and that was reintroduced into the state legislature in January, and it's been steadily progressing. So we might see another few states following California's lead. And I'll just briefly, so we've kind of covered Europe, we've touched on the US briefly, and then obviously there's the rest of the world, which is quite large. So in the rest of the world, it's all about the International Sustainability Standards Board standards. So they launched their standards back in June 2023. And the aim there was really just to get a consolidated disclosure framework for companies and investors around the world, just to make it a bit easier. But I would just say it actually only takes effect if jurisdictions adopt them. So at the moment, about 40 jurisdictions have already decided to use or are taking steps to introduce the standards in their legal or regulatory framework. So those standards, there are 2 of them. The first one is kind of on general sustainability related risks and opportunities, so very much from the financial side. And the second standard is on climate. So if you look at the from a Europe perspective, the reporting is quite wide. The ESRS do cover different areas across the E, S and the G, whereas you can see there that the US was all about climate, and the ISSB standards are largely focused on climate as well. So I'll just quickly say that close to home on the 25th of February, the UK finalised their UK sustainability reporting standards, which are based on the ISSB standards with a few amendments, which have been endorsed now for voluntary use with a bit of a consultation planned to see if they're going to become mandatory for companies, and most likely it's going to be mandatory for listed entities from the very beginning. So I'm just going to pass over to Luke, who's going to take you through a bit more on all things climate.
Thank you, Catherine, and good morning, everybody. With this section focusing on the why and how companies are engaging with sustainability, it would be interesting at the outset just to get your own perspective on the factors impacting your own sustainability ambitions and activities. So to get us going, and similar to Catherine, you'll just see shortly a poll on the screen asking you to select the 3 most relevant factors in terms of their impact and influence on your own sustainability ambitions and activities. Just look and see what the insights coming back from you all are. Because interesting results come through, so kind of linked to what Catherine had been highlighting, that, you know, regulatory compliance is still the principal driver, but we're starting to see new drivers of activity emerge. So kind of the need to kind of drive operational efficiency, trying to meet customer expectations, and then starting to see that impact of investor pressures. I think these kind of insights are sort of starting to see what we're viewing in the marketplace as well. So from a market perspective, and so from a sustainability strategy and activities perspective, we're seeing a significant pivot in the market in terms of the activities and services that are being provided to customers, but also in terms of how companies themselves are engaging with the sustainability and climate transition. So what those poll results show, and what Catherine's insights have highlighted, is that CSRD and regulatory compliance have historically been the principal driver of sustainability activity. But that's no longer the case. Sustainability is no longer just about reporting, it's about resilience and it's about growth. And what we're seeing is that this pivot has been driven by two key realities. The first of these is the broad recognition that climate and sustainability risk is already a material financial issue for businesses. So impacts are already hitting earnings, they're hitting operations. We know that extreme weather events are causing supply chain disruption, they're causing asset damage, and they're impacting earnings volatility. So this is not a future dated risk. We know that the conditions for more significant events with more significant impacts in more locations are already in place. We just have to look at the world in which kind of businesses are trying to operate, but locally from an Irish context, across Europe and across the global markets. And that climate risk is becoming a significant challenge that needs to be addressed today. At the same time, we know that financial impacts are expected to accelerate, not stabilise. So physical climate impacts are expected to increase over the coming years, regardless of the levels of decarbonisation activity within the economy, and that these will drive exponential, not linear effects on costs, on assets and supply chains. So we just need to look at some insights in terms of how material have these impacts been. In 2025, a report from the European Environment Agency identified that the economic costs from climate-related events in Europe had reached an annual cost of €44.5 billion across the on an annual basis between 2020 and 2023. This had represented a 2.5-fold increase on the previous decade. The analysis also pointed to kind of significant cost rises to deal with climate risks in the future. So by 2029, there's an expectation that economic losses resulting from climate events in Europe could cost €129 billion annually. More closer to home, we've seen the impacts of the recent flood events, but last year we had the significant event of Storm Owen. And that standalone event cost the economy roughly $300 million in mitigation and adaptation costs. And then we had the huge events in California, those wildfires. And when we look at the 10 most significant weather events in globally last year, those 10 events alone had a net cost of €100 billion. So it shows that kind of climate events are having a material impact on businesses and the global economy. At the same time, current events remind us that climate risk is not the only factor that's putting value at risk for companies. Geopolitics and their potential to impact supply chain, energy supply and access are also key drivers of risk value. And investing in sustainability, while those actions, which we'll talk about shortly, can help with preparation for climate risk mitigation, they can also deliver a co-benefit in that they can offer further resilience against some of these wider geopolitical issues that are emerging. At the same time, one of the other drivers, obviously, is that kind of, regulation and finance will force faster action. Transparency and compliance requirements and investor pressure are accelerating action. They're kind of reframing how we look at climate. So climate is no longer being viewed from just a medium-term issue. It's an immediate commercial discipline that companies throughout their leadership structure, from CEO level down to the chief operating officer to procurement, need to start understanding and taking strategic action to address these issues. Last year, the PwC Global CEO survey highlighted that 66% of CEOs faced trust concerns in the last year, and that many of these issues linked to issues regarding climate change and transparency. So the first key driver is this recognition that climate and sustainability risk is becoming a material financial issue. The second key factor driving this pivot is the paradoxical situation that the energy transition is both accelerating and failing. So we can see that the global economy is decarbonising. Carbon intensity, which measures the carbon associated with economic production and activity, continues to fall year on year, with this fall being driven by the increased grow out of clean energy sources and the transition to a low energy economy. However, at the same time, economic growth and rising energy demand is outpacing clean energy supply. So despite record levels of build out of renewable energy, rising demand for energy driven by the data revolution and general economic growth are offsetting some of these gains. So this rising demand for energy and the need for the energy transition is driving significant transformation, both at a macroeconomic level, but also within organizations and how they frame their energy strategy in terms of resilience, use and cost minimisation. And at the same time, the failure to result in any net increase in emissions continues to contribute to global warming, and that these conditions are ever increasing the probability of more extreme weather events and the chance of those events to impact on business activities.
Excuse me. Thanks, Luke. So that was really interesting, and I love the examples, Luke, and hopefully it's brought it to life for people in terms of this is definitely more than reporting, and this is real world stuff. When you're out dealing with clients, and what are the implications that you're seeing, Luke, of these realities for business sustainability strategies and the actions that they're taking?
Yeah, thanks, Fiona. So I guess when we look at these two realities, so kind of that acknowledgement of climate and sustainability risk presenting material financial costs, the realisation of the energy transition, like each of these realities, each on their own or in combination, they have major transformation and financial implications for businesses. So these two realities there's higher earnings volatility from physical climate disruption, there's greater capital scrutiny as investors reward resilience and downside protection, and fast-moving regulatory and financial consequences for non-credible action. So there's a need for organisations to be able to present both a credible action plan in terms of what they're doing to address these risks, but also how they're increasing their internal resilience to kind of address these emerging challenges. So the transition alone will not protect businesses from mounting climate risk and financial exposure. These are not policy choices. So companies are going to have to kind of undergo a sustainability transformation and embed sustainability within their core business activities. And this recognition of climate risk is starting to become real at the C-suite level. So we saw this year that 44% of CEOs at least acknowledge climate risk. So there's a recognition that climate risk could lead to significant financial losses in the coming year. But despite this recognition of the risk, few organizations are actually systematically integrating climate risk and opportunities into their standard risk operations, into strategy development. So if we just take the example of three key components of business operations, so supply chain, strategy development, or product design. So if we look at supply chain, only 21% of organizations have defined processes for integrating climate risks into supply chain. From a strategy perspective, only 25% of organizations are integrating climate risk into strategy development. And then when we look at product design, that's where we see the highest level of engagement from a climate risk perspective. The question obviously then is how can organizations, or how are organizations moving from climate and sustainability risk to actually turning that into some level of value? And what needs to change from a leadership team perspective? So the first key step is, embedding sustainability factors into decision-making processes is how leaders are starting to protect value and potentially start to unlock new revenue. So what we're seeing from the companies that we're working with is that, sustainability is no longer treated as a separate issue. It's not an agenda in its own right. Sustainability and the actions and activities that can underpin sustainability, they're starting to become part of the solution in terms of how you can potentially protect cash flows, investment returns, how they can support growth and strategic opportunities. And how organizations are starting to do this is that they're starting to look at actually embedding a range of sustainability actions through their strategy development, right through to kind of actual on-the-ground operations across their organizations.
Thanks, Luke. And I guess what's next? If you were a business out there, what's the next move that people should be thinking about?
I think the next move for all organizations is it's that integration piece. So how do you start integrating sustainability and climate change factors into the decision-making process? And the first step is to look at your organization and focus on those sustainability actions that can drive business value, that can help accelerate transformation, transparency, and resilience. And what this means is that, as Catherine had pointed to earlier, that while there was the pushback on sustainability engagement in different parts of the world, that reframing sustainability in a commercial strategy perspective is helping to integrate sustainability within core operations. So businesses are now focusing on sustainability activities that they consider as no regret actions. So what are those sustainability activities that can have a strong business case, that can stand up alongside the commercial strategy delivery? And I think a key byproduct of the new reporting requirements in sustainability is that many organizations have expanded their store of sustainability data that it can actually help to feed into this decision-making process. So while regulatory compliance was a key driver of sustainability activity historically, we've now got the added benefit of actually being able to use and interpret that data to support our delivery of commercial strategy. And with better data at hand, there's an opportunity for organizations to move from a risk management perspective to a value creation perspective. And I think that while every company will have a unique set of sustainability factors that will influence their ability to create value, our experience working with clients points to 5 interconnected topics and a range of underlying sustainability actions that we believe can actually drive value creation for most organizations. And we've just highlighted on the screen here what these 5 interconnected topics are. So if we look at value at risk, and within each of these, there is a role for sustainability actions. So what does value at risk mean? It means how can sustainability be used to help protect business value from financial, operational, and supply chain threats caused by climate risks such as extreme weather events, climate impacts on your operations, on product sourcing, etc. But also value at risk that we highlighted earlier, the impact of geopolitics in terms of your operational execution. So how is there a benefit for sustainability in supporting there? From an energy perspective, organizations are starting to look at how can you optimize your energy efficiency, minimize expenditure exposure, especially in the current world, and the need to kind of look at how you can modernize your infrastructure from an energy perspective and secure your access to clean, renewable energy sources. Supply chain is not a topic that is unique to sustainability, but sustainability is a key role in terms of how supply chains operate. We know supply chains are facing significant pressures. There's the role of shifting tariff, there's geopolitical tensions, and obviously there's escalating climate risks they're straining operations worldwide. When you add in the rising demand from increased transparency and traceability across supply chains, the need for a modernized supply chain with well understood sustainability data insights is becoming a key license to operate. It's not just a nicety to have. I think we all know that the transition from a climate perspective, unlocking those benefits, managing climate risk, there is significant cost involved in that. But linked to kind of the topic that Sinead will talk on next, there's a wide range of finance, credit and incentive supports out there that can actually help businesses in unlocking the benefits from that climate transition. And then finally, from a regulation, data and technology perspective, navigating regulatory and data complexity is more challenging than ever. But having insights on data, using your data is key to kind of understanding what sustainability means for your business and how this can be used to support regulatory readiness, but also to support commercial strategy execution. So when we look at these 5 topics, what are the sort of the no regrets sustainability actions that we're seeing businesses start to focus on? And from our engagement with clients and conversations in the marketplace, we've seen the emergence of a suite of about 8 no regret actions. So those actions that have a strong business case can support the emergence of business value. So what should companies start to consider? Well, first of all, understanding climate and sustainability's business, financial and tax impact on your organization through activities such as climate risk scenario analysis is a key no regret measure. How do you reconfigure your strategy to navigate climate risk? So using insights that emerge from climate risk scenario analysis. Transforming supply chains to accommodate sustainability risks and opportunities. Looking to enhance operational resilience while decarbonising through the development of energy strategy, energy efficiency programs. These are all activities that are helping just with general operational efficiency improvements, but they have a strong link back to sustainability and decarbonisation. Looking to use sustainability factors and insights from risk analysis to feed into your market M&A strategy activity. Key then is kind of how can you actually unlock the value associated with the climate transition? So how do you manage tax and other incentives to improve the business case throughout the full decarbonisation and energy efficiency investment cycles? And then finally, how can you evolve your strategy and operations through using sustainability data optimization, getting ready for regulatory change engagement? So all of these actions, they feed into kind of supporting a wide range of interconnected sustainability topics that support commercial delivery as well. And I think kind of, as we said at the outset, one of the key issues is the cost involved with the climate transition. And I think now I'll just hand over to Sinead, who's going to highlight some of the key insights in terms of how credits and supports can improve the business case and drive sustainability and commercial activity. Sinead.
Thanks so much, Luke. And I think we're also going to start with a survey question there. If we could pull up the tax one, that would be great. So I think it's going to be around what is the biggest barrier to accessing grants and tax incentives for decarbonisation projects. So it'll be number 1, lack of awareness, 2, difficulty keeping up to date with changing tax rules and subsidies, 3, complex eligibility conditions, 4, administrative and compliance burden, and 5 is other. So I might just take a minute or two, and I might just, I'm conscious of time as well, kick off while we're waiting to see what the answer to that one is, but I might just keep going with my presentation for the minute while we wait for those to come through.
I think today, based on the initial results, there'll be lots of interest in terms of what you're going to talk about, because quite a bit on lack of awareness of available grants and tax incentives. So hopefully people get some real value out of this next piece.
Thanks so much, Fiona. So I suppose, as Luke would have mentioned, you know, if you're going to try and unlock the benefits of and manage the risks associated to climate transition, that is going to need a capital investment. And that capital investment is going to need to be financed. And that could be through either, for example, you know, your mainstream sources, such as your debt financing or your private equity, or looking at those kind of climate tools like grants and incentives. And I suppose for me, and just to set the scene, I would say that the role of tax policy is kind of a key role in our energy transition. We've seen like governments around the world use tax policy both as a carrot and a stick approach as one lever. And they do that to kind of mobilize your decarbonisation investment. They do that to influence behavioural change, to support innovation, and to help fund a just transition. And that, I think it's fair to say, has resulted in an evolving, you know, and complex and sometimes challenging tax environment. So maybe just to give a few examples under 3 of those. So I suppose in terms of steering behaviour, if we even turn to Ireland, we've seen things like our plastic bag levy and carbon taxes, which are in the news a lot at the moment, but they're being used to kind of steer consumer and business activity towards those lower carbon options. Then turning to, I suppose, the mobilisation of private investment, the carrot approach has tended to work really well here. And I suppose one of my favourite examples over the last number of years has been the introduction of the Inflation Reduction Act in the US market. And that resulted in a massive amount of clean energy investment in the US, with kind of those tax credits being a key part of that policy. Then if we turn towards Europe, we have seen over the last couple of months a number of countries tap into the Clean Industrial Deal State Aid Framework, or CSAF, to get approval for the introduction of tax credits around creating new manufacturing capacity for those clean technologies. And we have seen schemes approved recently in Germany, in Greece, and in France as well. I suppose then turning closer to home, we have accelerated capital allowances for investment in energy efficient equipment. And I'll talk to that a little bit more a little later on. So I suppose then innovation, and that is really critical, I suppose, in developing the new clean technologies we need for our energy transition. Lots of supports there. There's lots of grant funding, but one in particular, which is a very valuable tax relief, is the R&D tax credit. So that gives you, from the 1st of January 2026, an effective 47.5% tax saving via the 35% credit. And then you also get your normal regular 12.5% corporate tax deduction. We'd also love to see a tax credit introduced around innovation in projects with kind of those decarbonisation and green objectives. The Department of Finance, in their recent R&D tax credit and innovation compass, have said that work will continue in 2026 towards the introduction of that innovation tax credit. So it is a wait and see for now.
So Sinead, it's clear that there's lots of tax opportunities on the funding side, but for companies taking that next step to invest in decarbonisation, when's the right time to involve their tax team or their tax advisor in the process?
Thanks, Fiona. Very good question. So I think it's really important, first of all, to recognise that if you tap into those grants and incentives, you're very much going to be saving money. You're going to be reducing your cost of investment and also, helping improve your return on investment for companies in particular who are tapping into those energy efficiency and renewable energy sources. Like we've recently worked with a client where we have identified that up to 42.5% of their project spend in particular areas can be reduced via those grants and tax incentives. I would say that it is really important to involve your tax teams early on in the process. So my recommendation to all companies is that they should really map out those incentives early on in the process and also pay attention to eligibility criteria and conditions. And I suppose the reason for that is, unfortunately, we have come across situations where a grant application is denied because project spend has been incurred even before the grant application was made. And also we've come across situations where for certain tax incentives, not all, but an election may be needed in a tax return and that's forgotten. And that's resulted in the withdrawal of a tax relief, which can result in tax to be paid and interest and penalties. So really important to keep an eye on that. So I'm going to turn then just to this slide, which kind of focuses on the different types of green taxes and incentives you need to think about as part of kind of decarbonisation projects. I don't have time to go into every point on this slide today. So what we're going to do is we're going to share the slides after the webinar, and you'll be able to kind of look back as a reference point. The other point I think that's important to bear in mind is that this is just focused on the Irish market, but there are lots of incentives available globally. So just to bear that in mind. And we do work with clients. I think we've recently done work with one client where we've helped them identify grants and incentives in Ireland, the UK and Italy because they had a global footprint in those particular jurisdictions. So I suppose today I'm going to focus on, firstly, the accelerated capital allowances for investment in energy efficient equipment. And what does that do? That gives you a 100% write-off for your qualifying cost of your investment in the year that that piece of equipment is put into first use. Again, really, really important to keep an eye on the eligibility conditions. So for example, equipment needs to meet certain performance criteria for its particular class of technology and also be listed on the EEE register with the SEAI, which is the Sustainable Energy Authority of Ireland. Also, if you get grant funding towards that cost of equipment, your allowances are calculated after deducting that grant funding. So kind of it's really important to factor that into the case. The other thing is that there's a time limit. The scheme only lasts for a period of time, but we were delighted to see in the recent Finance Act that that was extended to the 31st of December 2030.
Today in the poll, about 20% of people said that complex eligibility requirements were part of the challenge here. You've mentioned about the EEE register. So is it the case that there's broad categories of equipment that are listed there, and once that category of equipment is there, you're entitled to the accelerated capital allowances? Is that how it works?
Unfortunately not, Fiona, and a really good question as well. So what you need is the manufacturer of products to register each product on the register. So what I would say, what I say to all my clients, you know, we have come across situations, for example, one client bought 2 different types of solar panels. One was listed on the register, the other wasn't. So you ended up in a position where you were only entitled to accelerated capital allowances for the solar panels that were listed on the register. So look, what I would do is, if you're thinking of buying a piece of equipment, you can go onto the SEAI website and you can search by product code. So first off, go on to the register, see if the product is there. If it's not there, it's also possible to go and approach the manufacturer and ask them to register the product on that EEE register. But the key thing there is that you need to make sure it's on the register before you actually make the purchase. So then maybe, I suppose, just pulling back just for the couple of minutes that I've left, it's just worth also just referencing grants, because there are lots of grants available from lots of different sources in this space in the Irish market. So we see them with the SEAI, the IDA, Enterprise Ireland, and your local enterprise offices. And grants are available for everything from kind of training, helping you to develop a decarbonisation plan, to the kind of help with those capital investment programs. Again, really important to think about, you know, what are the eligibility criteria? Some might depend on whether you're an SME or not. But I would encourage everyone to do a bit of a horizon scan and see whether grant funding is available. For any companies that are doing maybe R&D and those pilot programs, there can also be funding available through some of the EU funding pots. So the most common we'd see is the EU Horizon Fund and the EU Innovation Fund. So also, just before I move to the next slide, there is a link there with useful resources that you can get more background information. So then finally, and just quickly, just to wrap it up, I thought it would be helpful just to do a quick little case study to put it all together. So we have X Limited, which is an Irish manufacturing company and a client of Enterprise Ireland. They're concerned about increasing energy costs, and they'd like to put a decarbonisation plan in place to reduce their greenhouse gas emissions. They'd like to upskill 4 employees to drive that decarbonisation plan, and a training plan has been prepared. And then following the development of the decarbonisation plan, they're considering investing in industrial heat pumps, which have a cost of about 1.5 million euros. So you can see there, just maybe starting with the grant funding, Enterprise Ireland have a climate action voucher of, you know, up to 1,800, which is available to help fund the independent advisory support to develop that decarbonisation plan. There's also a Green Plus grant, which is a grant up to 50% of eligible costs, up to a maximum grant of 50,000 euros. And then for the heat pump investment, you can have a potential grant ranging from 20,000 to 1 million per project. So really valuable incentives available there. And then just turning, I suppose, to the tax incentive, if we assume those heat pumps are on the EEE register with the SEAI, and you get a grant of 400,000. So to calculate the amount that qualifies for those accelerated capital allowances, you take the total cost of the 1.5 million, you can take off the grant of 400,000, which leaves you an amount qualifying of 1.1 million. So you can claim that as a deduction in your corporation tax return, and that gives you a tax saving of 137,500 euros, which is essentially the 1.1 million by the 12.5%. So if you take the grant and the ACAs into account, you have kind of about 36% of your overall cost has been funded via those grants and tax savings. So I'm going to pause now and hand you back over to Fiona. Thank you.
Great. Today we might take a few questions now, so I will start running through some of the ones that have come in. Unfortunately, we won't get through all of them, but as we said, anybody who has asked a question, if we don't get to it, during the webinar, we'll respond back to you separately. So there was a question that came in about the differences between the current VSME and standard and the future VSME. So the VSME is the Voluntary Sustainability Standard for micro, small and medium-sized enterprises, for anybody not familiar with it. It came out originally quite a while ago, and originally was designed for those smaller companies that weren't going to be in scope for CSRD. So I suppose it was designed with kind of less than 250 employees in mind originally. Now, what we have heard from the EU is that it doesn't seem to be their intention to do a major overhaul to it. So even though it now might apply to companies with 999 employees, as in those just below the CSRD thresholds, I think they're very reluctant to start, kind of expanding on the VSME at this point in time. And really the only changes that have been signalled is that they may do some that just help it align better to the updated ESRS standards that underpin CSRD. So we're not anticipating a wholesale rewrite of VSME or anything like it, just that it will be applicable to a wider base. But equally, there is, at least some encouragement by some quarters for those companies that are within, that VSME wasn't originally planned for. So those between kind of the 250 and the 999 employees, they may consider still reporting under CSRD voluntarily as well. So that is another option for larger companies to think about, and whether or not, very much kind of some of the things that Luke talked about, does that fit in with their strategic priorities? Will they get value out of that? They should be the first most important things that you think about in terms of what are your what are your key stakeholders asking for. But just to close out in the VSME, the European Commission is expected to publish a delegated act containing the VSME standard in June 26. So that will be based on the current European Commission recommendation, and we'll see when that comes out exactly what is in it. There was another question as well around whether or not, if the original CSRD legislation has been transposed by a country, is transposition of the CSRD updates required. So as far as I'm aware, it is, and certainly in Ireland, the way that the legal structure is set up is we would anticipate that it will require transposition locally in Ireland in order to bring that change in. Okay. In terms of some other questions then, Luke, I've got one for you. If companies could only undertake one sustainability activity, what activity would you recommend and why?
Thanks, Fiona. So I think if we assume that everybody has got their data in place, given all of the regulatory readiness, I think kind of climate risk opportunity scenario analysis is a key activity to focus on. I think one, because it just gives a clear insight across the full value chain. So what is in organizations physical risks, but also what are the transition risks? So kind of what risks could emerge from regulation, from changing consumer sentiment, from procurement processes. And it allows an organization to do an initial high-level screen. And so like, what is the long list of physical and transition risks that you could be exposed to? And then working through with your senior leadership, you can come up with a nice succinct list of here's our priority 5 or 6 climate risks and opportunities that we need to be aware of. And also it lines up with traditional risk management, that, this idea of trying to integrate sustainability within general strategy and operational perspectives, and see your climate risk and opportunity analysis as a framework that allows that integration to happen and provides an additional level of insights to support strategy, feed into M&A activity, etc. So I would go with scenario analysis. And then, it can be qualitative at the outset. And once you've identified that short list of priorities, then you can go a next step and start to do a quantification to understand, well, what are the real material impacts that could emerge from this? And then what's our strategic or mitigations that we need to consider?
Yeah, and I think that qualitative piece is really important, Luke, because scenario analysis can be a little bit frightening, almost for companies if they've never done any of this, and can see very in depth. But I know we've certainly worked on quite a few together at this stage, because obviously it's important for strategy, but it can also be important for reporting. And starting with that qualitative piece, I think, is a really nice introduction to the topic, and getting people familiar with the concepts and getting them kind of thinking about what might happen and so on is, I think it's a really useful place to start. Thanks, Luke. Sinead, there's one here for you. Are there any other corporate tax issues you should be thinking about before availing of these tax incentives and grants?
Thanks, Fiona. Well, I suppose I might I would recommend that people kind of look at whether, if they're going to avail of something like the accelerated capital allowances, that creates a taxable loss or not, because you need to think about, you're not going to get the benefit upfront in that. It's just going to be spread over a number of years as you use those losses. Also, for some countries outside of Ireland, there can be restrictions around the use of losses. So again, you need to just factor that into your process. And then the other one is just to keep an eye out for it's a regulation called the Foreign Subsidies Regulation. And that gives rise to an EU notification and approval process where you have a company that has tapped into financial contributions from governments outside of the EU. It's an important one to bear in mind, and just to say, like, financial contribution is very widely defined. It kind of refers to things like subsidies, grants, and tax incentives. There are thresholds, but just to keep an eye out and to check those as well.
Okay, thanks, Sinead. Conscious of time, and I'm sure people would like to have a minute before, no doubt they have 11 o'clock meeting starting. So I know there was a query regarding whether or not there would be, they'd be able to access this webinar again later. So yes, we will put it up on the website. If you missed any piece of it, you can go back and watch it at a later date, or please feel free to send it along to your colleagues if they missed out and you think it would be of benefit to them. So just to wrap up, I have to say thank you to our speakers who've been so generous with their time this morning, sharing their own valuable experiences and insights. And thank you to each one of you for giving up your time to join us. I hope you're leaving today with some practical insights and new ideas that you can take back to your own teams and organisations. And whatever point your company is at in its sustainability journey, our sustainability team here at PwC are on hand to support you. Thanks again, and I'm looking forward to talking to you again very soon. Take care and enjoy your day. Bye.